here's to me what I would think a portfolio, a well-rounded portfolio would look like. Now, here's a disclaimer, is that I say it's perfect, the perfect public portfolio, only because I think it's perfectly balanced. Risk tolerance, keep all that in mind. But I'll run right into it. So, positions, 10 to 25 positions. I think as you move above 20, it becomes unmanageable. The closer you are to 10, you want to stay diversified, but you want to be able to keep your fingers on the pulse of the stocks that you have in your portfolio. So you always want to like be abreast of this, right?
Yeah.
I said breast. So 10 to 25
Just so
stocks.
mature.
About 25 is when I feel like it's getting to be a little bit too much. The next thing I would say is growth versus value. And I think this is where a lot of people got in trouble, us ourselves included, with the stay at home and reopening, because we were getting fat and happy, and it was just easy to get in tech growth. No matter what happens, I think I will always have exposure to tech growth, but
Yeah.
I would say 45% of your portfolio in growth and 45% in value. And I think 2 to 3 industries of each, that makes up 90% of your portfolio. Now, depending on your confidence and the market conditions, that can be a sliding scale. But if you just want to be balanced, 45-45, call it a day. But if this was rewinding back to stay at home, COVID, you may increase the growth, specifically tech growth, to 50 to 60, or sorry, from 45 to maybe 60, even 75%. But you still want the exposure in the value, because those are the opportunities. Always having the opportunities and being able to deal with the ebbs and flows of the market. So let's say 45-45. And of that growth, being careful not to be overexposed in tech. It's very easy to be overexposed in tech. If you do, make sure you're mixing up industries, but half of that 45% max would ideally be in tech growth. Value stocks, same thing, considering a couple industries, and I would encourage that to include dividend for revenue. They're a little bit slower movers, but if you have that cash flow, as the market moves down, the yield goes up, so that should help you and benefit you. So again, no more than half of that 45% in dividend. So 45-45 growth value, 10% in hedge. And right now for me, that is crypto, specifically Ethereum, but that can be gold as well, depending on what you like. And you could also say that could be real estate as well. And when I say real estate, I'm not saying the full value of your house. I'm saying whatever you put down, the money you put in, that could equate to about 10%. Hedge could be up to 25%, but above that is no longer a hedge. It's actually a main investment. So the basic breakdown would be 45-45-10. That would be well balanced. I have key considerations, which I can run into, or do you want to comment on those?
No, I just wanted to say that I think that that's actually a really great strategy for anybody who's looking to just have a well-balanced portfolio. And this would be something that I think that probably caters to those who are looking more for long-term type of, like if you're looking for 5 to 10 year kind of time horizon. And there's definitely cases you can make as far as a shorter term as well. But if you had questions as to what exactly a value stock is, I think that you look at companies like Disney, Verizon, Caterpillar, those stocks that really don't have any more room to grow, but continue to just do well and sustain and have that dividend. Those are the kind of stocks you want to take a look at. Energy, all that good stuff.
Yeah, and I would even say I don't think this is short-term swing trade, but I will say this is long-term swing trade. I would say this is, if it's a year, I think that could work, because again, like you're adjusting sort of your balance. But absolutely, for an active investor that's a long-term investor, for sure, this is the most ideal sort of consideration.
Yeah.
Here's some key considerations for this. Position max leverage, 10%, ideally. I go up to 15%. You go a little higher. Spec positions. This is the most important, and I think this is where I see most of my friends getting in trouble, is they're overly speculative.
Yeah.
Pick your highest conviction spec.
Everything's a penny stock.
And don't let your aggregate specs be in over 25%. Hopefully.
Yeah.
It gets really hard to do that. I've been in that trouble with that situation as well. But overly speculative stocks, 25% should not take more of this portfolio account. Understand your risk tolerance. No bucket to me, should have 0%, but they can all be sliding scale depending on your risk tolerance. I have friends that have very low risk tolerance, so they should increase their value stocks, increase their dividend stocks, less growth. Their speculative may only be 5% or 10%, but that should be sliding scale.
Yep.
And the goal for me is always outperforming the S&P for a long-term investment account. If it's a short-term swing trading account, to be quite honest, beat a savings account. Be in the green. That's all I care about, because you're likely going to have high upswings, but you want to end green. You're going to have those 20, 30% years. You could potentially have a 1% year. It doesn't matter. But at the end of the day, for these accounts, beating the S&P is really what you should be going for. Yeah. We'd all love 50% wins, but I think we get sometimes a little too hung up on that.
Yeah.
To do 10% a year shouldn't be that hard.
Right.
And this is the type of portfolio that should help you get there.
Yeah, it really comes down to discipline and how disciplined you are.
Yeah.
And that comes with time and practice.
So to me, that is a perfectly balanced portfolio. Brad, what say you?
I think I like this a lot. I also like what Oliver Thorpe said. I think you can have two portfolios, one long-term, one swing trade, or shorter term, and that's how I like to do it. And honestly, that's how we've modeled this channel. Fat Man Zoom's more focused on long-term approaches, whereas I'm kind of more short-term swing trader. Not that Fat Man Zoom doesn't do that, but that's kind of the lanes that we've kind of found ourselves in. So I really like that, and I think that that's a really good approach that if you guys are looking to either get into investing full time or want to have like a nice nest egg that you can retire on, but also mess around in the market some, I think that this is going to be the best channel for you as well. And I think it's a really good approach too.